Welcome to CS Week Success Stories, second Tuesday at 2 p.m. Eastern webinar series. These webinars are the top-rated workshops from our attendees for Conference 39, held last May in Charlotte, North Carolina. I am John Sild, and I'm with CS Week, and I'll be your moderator today. Denise Mollendor will be your host. CS Week and Conference 40 will be April 25th through the 29th. 2016 at the Phoenix Convention Center in Phoenix, Arizona. This program will be recorded and available for playback along with our other archived presentations. You can find it under the Educational Venues Webinars link on our website. Attendees are encouraged to upload questions to the Q&A panel on the lower right side of your screen. Be sure to click the All tab and make sure that I will see your question. We will wait until the end of the presentation to answer the questions. Today's program, Optimizing the Escheatment Process. Our guest speaker is Raquel Solomon. Raquel is the manager of meter systems and data management for Eversource Energy. Previously, she supervised processes related to billing corrections, sales tax adjustments, refunds, and key performance indicators and analytics. Raquel has also received a certification from the Boston University's Corporate Education Center as a Business Solutions Analyst. We want to welcome Raquel today, and Raquel, go ahead and take it away.
Thank you so much, John. Okay. And bear with me just a moment as I start to navigate these slides. Thank you, everyone, for joining me for this presentation. For those of you not familiar with Eversource, we are the legacy Northeast Utilities and NSTAR companies that became one company brand back in February of this year. That one company brand reinforces our mission to deliver reliable energy and superior customer service. As you can see from the map here, our service territory extends throughout Connecticut, Massachusetts, and New Hampshire, making us the region's largest utility serving the needs of electric and gas customers. Our objectives this morning are pretty straightforward, or this afternoon rather, are pretty straightforward in that they establish a basis for the escheatment concept. They spotlight both positive and punitive incentives for understanding your own business process. We're going to also demonstrate the evolving strategy used to address all that was found during our own self-audit. And lastly, to keep us all from following or creating signs that look like the good luck one you see there on the left. So what is escheatment? Well, escheatment is a principle that originates with British law, and it was originally used to describe the permanent transfer of abandoned land to the King of England. So let's fast forward to some modern times and skip over the etymology of the word. So simply put, this means that unclaimed property should revert to a particular state if an owner doesn't claim it and no heir comes forward to assert a claim. So in the U.S., the concept has been adapted to apply to tangible and intangible personal assets. And of course, since we have no king, the assets go to state government. But what does escheatment include? Well, escheatment includes all forms of property, both tangible and intangible, that become abandoned by a rightful owner. So some common types of intangible property are uncashed checks, customer credit balances or refunds, security deposits, dividend checks, corporate securities, insurance refunds or claims, sometimes wages, and that names a few of the types of abandoned property. So the purpose of escheatment laws is really to reunite owners with their property, but the laws also protect the holders of abandoned property from subsequent claims by an owner after that property has been transferred to the state. This also ensures that any economic windfall goes to the state and not the holder of property. Ultimately, escheatment laws provide that a state become the legal owner of abandoned property based on the concept of state sovereignty. So naturally, of interest to the state would be any business that fails to escheat or turn over abandoned property, which leads us into a discussion on recent spikes. So there are a variety of factors contributing to the rise in abandoned property. So many of us are familiar, of course, with the 2002 passage of Sarbanes-Oxley. And that passage forced companies really to tighten their auditing processes, and it also placed emphasis on the fact that adequate internal controls are a responsibility of company management. Hefty fines and penalties are prescribed for noncompliance due to sloppiness or willfulness, courtesy of the Sarbanes-Oxley passage. And given the harsh punishment for noncompliance, more and more companies are tightening their auditing processes and starting to hand over more unclaimed money to the government. Some additional factors that contribute to the rise in the amount of money being collected by the government include banks. So, for example, banks have to transfer to state governments any money in an account whose owner has fallen out of touch with that particular institution. Additionally, some state treasurers express the fact that Americans are now more likely to move from city to city, resulting in them opening accounts but forgetting those accounts when they move. So transient behaviors are what lead us into the next slide on the differences between the states. So this particular slide highlights the 3 states that make up our service territory. And it's important to note that all states have unclaimed property laws requiring businesses to remit any abandoned property. But the laws are going to be different. So you've got laws regarding dormancy. And dormancy, simply put, is the period of time during which an owner of property doesn't take any action on that property. For example, Connecticut has a 1-year dormancy period for all unclaimed property, and Massachusetts, though, has 3 years. However, New Hampshire has 1-year dormancy period for any type of security deposits, whereas it's 5 years for all other credit types. Additionally, there are differences in the requirements for due diligence notification. For example, in Connecticut, due diligence notifications must be sent out by December 31st of the year prior to filing, and the state is silent on the threshold. And by saying silent on the threshold, what I mean is the state requires us to send a due diligence notice to all customers, regardless of the amount. So it can be a penny, and we still have to send out notification for that penny. But in New Hampshire, for instance, the notifications must be sent out not more than 120 days prior to filing, and the state only requires us to send out for property values greater than $50. Additionally, there are different filing deadlines. So Massachusetts and New Hampshire fall on November 1st, whereas Connecticut is March 31st. So again, those are a couple of differences between the 3 states that we serve, but they can be vastly different across the country. All right, so did you know that escheatment dollars are appealing from the state's perspective because they do not require raising taxes? And of course, states are looking for sources of revenue, and abandoned property may be that untapped source for the states. For the fiscal year of 2011, that $41.7 billion highlighted in that second bullet represents double what the states held just a decade earlier. And lastly, since there's no statute of limitations on credit balances or unclaimed property, audits and assessments of unclaimed property are something that can happen at any time. So failure to deal with this issue properly can impair a company's balance sheet, leading to other financial problems while also compromising company credibility and, of course, customer satisfaction. Well, in July of 2011, several of us bore a striking resemblance to our home alone friend here. We were informed by the state of Connecticut that we were about to undergo an audit of our unclaimed property and dormant property records. And that was the first time that any type of an audit of that nature had taken place. And it was just a couple years following a conversion, a CIS conversion. So the pandemonium that ensued was alarming, and it was confusing as well, because in preparation for that conversion for our CIS back in 2008, they had gone through a cleanup exercise. So what they had done was gone through all of the dormant credit balances and ended up doing a special submission to the state of Connecticut in excess of over $2 million. But since the new system had gone in, we hadn't had the opportunity to conduct our own self-audit on the new methods or the reports that were introduced for the Escheatment process, again, since that new system went live. So here's a list of some of the things that the state was asking for. And what I want to do is draw your attention to the last item. So that last bullet there says it's asking for the dates of any and all computer conversions or upgrades, as well as documentation outlining the upgrade or conversion. So the inclusion of this in the request, combined with that $2 million submission back in 2007, coupled with some other unexplained large filings for the company, prompted a whole lot of what-if scenarios. So this audit request really presented us with an intersection, and that intersection was, in complying with the request, what if we conducted our own audit or a process study? And some of you may be asking the question that many of us asked at the same time is, why would we want to assume greater risk in such an undertaking, since it could result in additional disclosures for the state? And the answer to that is very simple. We wanted to do what was right for the company and for the customers. And although we expected to spotlight pitfalls using this approach, we had no idea how many would be unearthed. Okay, so the framework we adopted for completing this request meant we had to analyze the request itself and all components of it. So for example, the state is looking for dormant property. Our approach had to be, well, let's find out why dormant property would exist. This framework also required assigning new eyes to old processes, meaning that we knew it would really behoove us to get some fresh perspectives as we explored how the property became dormant to begin with. So to find out what was happening, we embarked on a process study, and our mission was the pursuit of process pitfalls. And as you can see, we unearthed 7. So the next several slides, we're going to walk through each of those pitfalls that we discovered. So how did this journey begin? Well, the first part meant we had to really examine our data extracts. We had to disregard old reporting methods in order to do that. So the 2 areas of interest to the state that were also noted on that previous slide were unmatched cash and dormant credit balances. Now, we knew how many unmatched cash accounts we were supposed to have, and I really have to emphasize supposed to have. We knew we were supposed to have 8, and we knew that there was a process in place to address also inactive accounts with credits. And those credits were typically the results of an overpayment or cancel rebill, and neither one of those things should be foreign to any of us. Well, what we found with our brand new reporting was over 30 unmatched cash accounts with over $140,000 worth of payments. And naturally, since these accounts weren't subjected to the same oversight as the ones we knew about, this clearly meant we hadn't submitted any of the contents to the state in years. In spite of our dismay at this point, the decision to deviate from the norm in pursuing how credit balances and how property became dormant was really paying off. So what we did at that point was then shift gears over to the credit balances. So surely this wouldn't catch us by surprise, considering that this was an active process being executed every single week. So, but once again, we developed a brand new data extract, and we discovered 23,786 final billed accounts, totaling $2.7 million in credit balances. And what we immediately did was compare that extract against the report that was being worked in production every week, hoping for a backlog. And you know, that might seem a little alarming to say we were hoping for a backlog, but we were hoping that we had at least identified all of these things and we were just running behind in processing them. But what we found was that the original report was flawed. There was a discrepancy of over 20,000 accounts, so just over 3,000 of the accounts were what were on our regular reports. So changes and testing that should have occurred after the new system went live weren't given as much priority on the basis of credit balance identification being considered a simple report. So the extract that was in production was looking for specific conditions, and those were conditions that existed in the old system. But the new conditions and different account status types that were introduced in our new CIS C2 were never even brought into view. And so that's where the tunnel vision and the peripherally challenged probing comes from. So here you can see this is just a slide that shows the data. And if you look at 2010, we were hovering around 12,000 accounts, and the prior years were also around 12,000. If you look at 2011, you see that jump up to 50,000. That's where we identified the reporting flaw. And if you look at the subsequent years, you see that the number of accounts that are identified annually are significantly higher than what was previously identified using the old reporting prior to this exploratory effort. So the 23,000 accounts resulted in us having to assemble a special project team to locate customers for the refunds or to mark them for inclusion in a special submission of dormant property to the state. So we let the state know that we found these accounts, and they gave us 45 days to locate the customers to perform due diligence. So it was during this process that a trend was identified by members of this group for accounts with credit balances that were less than $200. And one of our states, New Hampshire, there was a high number of accounts that had credit balances less than $200. So we probed into this and learned that we just didn't do anything with accounts that had less than $200. And the reason was that we just didn't. So in our quest to go from 4 operating company models to 1, the process of credit balances, regardless of the reporting flaw that we just covered, was consistent for only 3 out of the 4 operating companies. So clearly we had an opportunity for synergy. This process study that we were on unearthed the second pitfall of just not doing it because we just never did, and this resulted in a new home for all credit balance processes. So all 4 operating companies at that point under the legacy NU structure handle these accounts the same way. Now, I think that we'd all agree there are certain things you shouldn't put in writing, and I don't think it's necessary for me to expound on what those things are, but procedures and processes, protocols are certainly among the things that all businesses should absolutely have in writing. So this task force that was, again, addressing the 23,000, they needed to be trained and they needed proper documentation. Well, it was at this point the reliance on oral tradition became clear. Processes were passed down from one person to the next in the same manner that a grandparent would share a recipe or a fishing lesson. So the process for everything from credit balances to S-sheets were either altogether undefined or extremely deficient in their content. So, of course, this made accountability impossible. And likewise, quality was subject to interpretation. In order to remedy this, we authored comprehensive process flows that not only told the how, but also told the why. And furthermore, we grouped all interrelated processes together under one supervisor in one area. Now, by analyzing the activity that was performed by this team working on these accounts, we uncovered another pitfall. And that was there was no reconciliation of uncashed customer refunds from the accounts payable system to our billing system, to C2. So what did this mean? Well, it meant duplicates. So this situation really started going, it seemed to go from bad to worse for us, because how on earth were duplicates possible? In essence, customers were getting multiple refunds for the same credit. And so in diving into this, we did this day in the life of a refund, and down the road in a couple of slides, we'll see what that looks like, the day in the life of the refund. But one of the things that we discovered was that, checks are only valid for 180 days. So what if a check isn't cashed within that time frame? Well, if that check remained uncashed, the accounts payable system would flag it for escheatment after 1 year, but our CIS system, so C2, would have absolutely no record of this. So what did that mean? Well, if the account was reopened and a customer stated they never received a refund, the call center could process a reversal of that transaction, which would bring that credit back onto the customer's account. Meanwhile, the accounts payable system had already assigned the uncashed refund to an unclaimed property status. So these two conflicting processes were being simultaneously executed for the same transaction, resulting in the duplication. So how did we fix it? Well, we worked with our IT in developing some automated reporting. So now on the first business day of each month, we receive a report of all checks that haven't been cashed in the 180 days. So why wait until a year passes? The minute they're no longer valid for being cashed is the moment that we need to reconcile them to C2. And this provides us with that opportunity, gives us ample time to perform that reconciliation by voiding out that refund transaction completely in the account payable system, reversing the refund in C2, and marking the credit for escheatment if no active service is found or the customer cannot be located. And this slide here depicts the activity of that new process that was developed in order to perform that reconciliation. And the expectation is that a continued decline will happen over the next few years. So if we take a moment to look at 2012, you'll see that we started this process with about 4,000 accounts. And the next year, we were down to 3,600. The following year, down to 2,700. In 2015, again, we're expecting to see lower numbers. But what I want to call attention to here is that 2012 represents only 4 months' worth of data. This process was introduced in September of that year. So this right here shows 4,000 opportunities that we were able to eliminate duplication. And for the following 2 years, 2013 and 2014, those are total years. So clearly the process is working. Well, we've obviously had enough to scratch our heads over with all of this, but we definitely had to keep going. So how did we get here? We learned a lot up until this point, but one of the things that we needed to peel back was what were we doing with all the accounts that when we had an opportunity to have further review. So for instance, return mail isn't a mystery for any of us. If it is, I'd love to know your secret. So refund checks, like anything else, are subject to being undeliverable, deceased, and all types of those types of reasons. Well, we learned during this process that while all other pieces of mail were being handled by a shared service group, the refund checks were sent off to our Treasury Department, who then sent them to billing, and it kind of took this long path, and they ended up really sitting on desks for sometimes months before being investigated for a new address or otherwise processed. So when asked why, the reply that we received was that this is what we've always done. And although this is closely related to that complacency pitfall that we discussed earlier, this willful indifference was worse in that we had tangible evidence before our eyes every day that these checks were being returned and we were just delaying, the review of them. So this meant that this discovery really meant that we were fueling our own inefficiencies. Principally, we were increasing the occasions for an uncashed refund to be duplicated. So, and furthermore, it also showed that such an action caused us to not provide our customers with excellence. So to resolve this, we established a tracking system and a lock bag control that requires all refunds that are returned to be logged and dispositioned within 1 business day. Now, you'll recall that earlier on, I mentioned the differences between states and the time frames that they mandate for notifying customers of dormant property. Well, in our case, we sometimes sent a letter and sometimes we didn't. It depended really on who was processing an account. So you'll remember that oral tradition pitfall. So if someone happened to be passed down this piece of information, yay for us and yay for the customer also. But if not, well, unfortunately, they didn't get that due diligence. So one of the other things that we found out during this process was that there wasn't a standard letter in our system for conducting due diligence. So the letters that were being sent out sporadically would have really given our corporate communications team that same Home Alone look that we saw a few slides before. We also discovered that procedurally we were missing opportunities to make contact with our customers at valid addresses because we had simply waited too long to issue the refund and then waited again to follow up on the return mail. So to resolve these issues, we first created an automated letter that complies with industry standards, and then we obtained licenses for our representatives to have access to the same LexisNexis skip tracing tools that are used by our credit department for collections efforts. And lastly, we shifted the paradigm from one that promoted due diligence as a one-time orchestrated event to one that promotes due diligence as a continual process that applies throughout each step of the process or account handling. And here is a summary screen of that LexisNexis tool. This is an example of some of the search results that can be obtained by using it. And you'll see there are different time-saving features and matching and linking technology that can help obtain the best search results. These searches can commence with very little information that you have on a customer, such as their social and even social media profiles. So it's a very helpful tool. And alas, we've arrived at the final pitfall, which is misaligned priorities. So although we have to give unclaimed money to the states, shouldn't we do everything possible to reunite it with our customers first, either by applying it to their delinquent and uncollectible balances or sending them a check? Shouldn't equal effort be made in returning refunds owed to customers as is made in the collection of receivables owed by that particular customer? So we discovered that our customer focus in this area was out of focus and quite limited. So there was this aha moment where we said, oh, yes, that's right, the customer. And we brought that customer back into view. I mentioned to you earlier in the process study that we learned the S-cheat was part of a much broader process structure, really. So this day in the life of the refund helped us understand what was broken in the credit balance process, both systemically and procedurally. And it spotlighted the need for us to develop a process and controls around return refunds, but it also yielded a brand new process to address uncashed refund checks. So you see that the S-cheats are actually the final step in this process. There's a lot that takes place before that. So looking at S-cheat as the one process, you have to realize it's part of a much bigger process, and it's usually the final step of a series of processes leading up to it. And we arrive at this slide with all of the data. So if you look at 2009, should stick out like a sore thumb. That's that $835,000 filing. And somehow this anomaly from this slide went completely undetected. Now, that particular year was the first filing post the CIS conversion, yet we never questioned this exponential increase in the submission from years before. As you've now learned, that year was laden with duplication. So in essence, we really did give money away. The next year that may raise an eyebrow is 2011, but I want to remind you that this was the cleanup year. So that's part of that 23,000 discoveries, the unmatched cash accounts. And you'll see that since that time, the activity has trickled back down to what would be considered normal. However, we're still looking for ways to reduce the number of times that accounts final with credit balances. So clearly process improvement needs alone were an understatement for what was uncovered, and the entire process structure is what needed to be defined, but I'm sure you're wondering right now what happened with the state of Connecticut. And the answer to that is full disclosure. Transparency and honesty were paramount regardless of the potential embarrassment. And as a result, we maintained credibility and were advised by the state that no penalties would be assessed. So they used this as a training exercise, which was indeed a gracious act on their part since they had not conducted such an audit before. But of course, we did receive a warning in case we decided to relax any of our processes and our oversight again in the future. But what happened to the $2.7 million? So here's what happened to those 23,000 accounts that we discovered at the beginning of this journey. So from the graph that you can see here, the pie chart, we applied almost 900,000 to over 9,200 uncollectible accounts and authored, yes, we put it in writing, a process to apply credits to delinquent and write-off accounts as the first step in the refund process. Using that LexisNexis tool and searching for active accounts within our service territory, just about 11,000 customers received refunds to the tune of $1.8 million, so that was a really big win for us and for them. And after all of this, the state ended up receiving only $75,000 as a result of the discoveries that we made. So I think that we'd all agree that this sign is a much better one than the good luck one that we saw earlier on. So at the beginning of this presentation, I mentioned that we had been presented with an intersection, and stepping into it allowed us to introduce new and strengthened controls, and also allowed us to introduce automated letters and tools to assist with locating our customers. And this, what it also did was allow us to understand or to gain a much broadened perspective of a process that had many parts. I think the identification of the 7 pitfalls speak to the benefits of conducting a self-audit in order to ensure adequate controls and safeguards are in place. But when it comes to overall company credibility, by taking this 360-degree approach, that's what we did. We maintained credibility. Had we not disclosed those findings or performed our own exploratory effort in the self-audit or process study, our public image would have definitely suffered a tremendous blow, and I dare say that the state wouldn't have been so gracious to us by not assessing any penalties or fines. Furthermore, the amount of time spent by our representatives in performing required due diligence was reduced by semi-automating the letter in C2 for due diligence notification, and this was another byproduct of the process study. We learned that there wasn't a formal letter being used, as you'll recall. We also identified an opportunity to completely automate the unmatched cash account process, and so those changes are currently still underway. We are also prepared for future audits, so there will be no more clutching our hearts or feeling like Macaulay Culkin going forward. And lastly, we have improved the commitment shown to our customers by refunding their money promptly when we have the best possible chance of reaching them.
Well, very good. Thank you, Rocky. What a great presentation you've just presented to us. I'm sure our attendees will agree. It was very informative. And so, hey, based off of that, I do have several questions that have come in. And here, let's start with this one. Lisa writes in, what happens to unclaimed property if the property owner has a foreign address? Good question.
That is a very good question. Actually, the state of the business, so the state of domicile of the business gets the funds. So say the business has operations in New York, New Jersey, and Maryland. Whatever the home base is for that business, that is the state that will get those funds. Very good question.
Okay, awesome. Next, our second question. What happens if money is cheated without a due diligence letter being sent?
That's a tough question because it depends on the state. So the states, going back to the, I think it was the third slide, how the states handle due diligence and dormancy, there's a difference. In the unclaimed property laws vary greatly between states. So, and that includes things like the due diligence requirements. So depending on the state, you could be assessed a penalty. Some states have a minimum requirement. So say you sent one, you escheated in New Hampshire, a credit balance of $10 and you didn't send a letter. Nothing would happen because the state sets the minimum at $50. So now if we sent one in Connecticut for $10 and didn't send due diligence, if that was identified during an audit, we could face some type of a penalty or some type of a warning, but there could be some action taken because we would not be complying with the state's mandate in Connecticut. But for New Hampshire, it would be different. What we did from a customer perspective at Eversource was decide to send due diligence letters to all of our customers regardless of the threshold. So Connecticut, we already know from a penny or greater, they have to get one. But New Hampshire, it's $50 or more we have to perform due diligence. Part of us changing that paradigm was implementing processes that say regardless of the amount, we are going to send a due diligence letter. We're going to do due diligence for our customers in order to reunite these credits with them before sending them to the state, because we believe that that would be greater customer satisfaction from our perspective. But again, going back to the question, it will depend on the state. You could be assessed a penalty or some other type of a warning, something of that nature.
Gotcha. All right. Just a curiosity question here is one that has come in. What's the largest individual amount is cheated?
Well, I've seen some for $20,000 be cheated for customers, but I don't have that individual one. I can't quote that one, right now because it could be something higher, although I've seen them for $20,000. But if we look at from a state perspective, the individual submission made to state would have been a $2,600,000 submission, or right around there, that we sent to the state of Connecticut for back in 2007. That was part of the cleanup. So that was the biggest single filing that we've given to a state. Actually, it was just under $2.1 million to the state of Connecticut back in 2007.
Very interesting. Well, Rocky, looking at our time and looking at what's going on with everybody's busy days, I want to thank you for your presentation. I want to be mindful of everyone's day and not prolong this. A quick note I want to make aware to all our attendees. The award submissions for the Expanding Excellence Awards is now open, so please visit our website for some more information. Again, I want to thank our attendees, and I want to really thank Rocky for joining us today and presenting this wonderful presentation. At this time, we'll conclude our webinar.